Hello guys, I'll be continuing this presentation with the next two investment accounts, which are TFSAs and GICs. So tax-free savings accounts was created in 2009, and although it's a recent account, it has provided over 5.5 million users in Canada the benefit to save their money. The advantages to this account is that there's no tax on gains. So any amount that you contribute to this account and it grows, it won't be taxed later. With withdrawals added to the contribution room, you can withdraw an amount and then later on have that amount that you can later contribute again. Another benefit is that with the 6,000 annual contribution room, if you don't use it up this year, you can always forward it to the next year, or if you use up only half of it, etc., you can just move it on to the next year, whichever is free. And also in this account, there's no mandatory withdrawals, unlike with RRSPs, where after the age of 71, you do need to have some restrictions there. So with disadvantages, this account does have a lifetime contribution amount, which is 69,500, which is not that big of an amount, but it's still a big amount to not have it taxed on. And if you go over the contribution lifetime, then you will be taxed 1% per month on your contributions, as well as any losses in this account are not considered to be withdrawals. But the biggest disadvantage that I think this account doesn't offer is the tax deductions, obviously, since the amount that you're contributing has already been taxed on. There's no deductions or reductions there. The next account that I'll move on to is Guaranteed Income Certificate, GICs. This account is one of the safest investment accounts that an investor can make. A GIC works like a special savings account where money is deposited and it earns interest. When buying a GIC, you are technically lending your money to a bank or a financial institution, and you are on a term which could be a few months or a few years. A purchaser can choose a fixed or a variable interest with a payment of monthly, semi-annually, annually, or until the contribution reaches a maturity date, which is compounded. A high interest is earned on investments with a longer term, and the initial investment minimum is of $500, and there is no fee to make a purchase of a GIC account. So some of the advantages in this account are that the amounts are protected, that the investments are protected by Canada Deposit Insurance Corporation, but this doesn't refer to United States, US dollar, or to the term if it's over 5 years. So anything from 1 to 5 is good, but if it's over 5 years, it won't be covered. Fixed rates on investments are guaranteed, as well as there's many options that are available for this investment. So you can hold the GIC in registered investment accounts like RSPs, RIFs, and TFSAs. Some downsides to this investment is that the investments are locked in. So there will be a penalty if you choose to withdraw your investment earlier. Let's say you have a 3-year term and you want to break it earlier or take it out sooner. You might be penalized with taking out early. The returns are very low and the gains are taxable in this case. So this means that the interest rates might be lower than the investment, and that means that it doesn't always keep up with inflation. I'll be moving on to our conclusion, which we have covered 4 accounts in this presentation. RSPs that offer tax deduction, but also, as they defer to a later date, the disadvantages that you can't really avoid the tax deduction in full. Our ESPs are a great investment for your kids and their financial educational future, but they're very strict with how you withdraw from this account, which means you will have to provide a lot of a lot of background information and to prove that your kid went to school, etc. TFSAs, like I said, are a great investment too because there is no tax on gains, but unfortunately with the limited lifetime contribution and with the no income tax deduction, it doesn't really help that much. And GICs are also great to invest, but because they have a fixed rate, you can get your return back, but not always. Returns are low and gains are taxable. For our recommendation, we chose RRSPs because of the advantage that they have to lower your income tax, as a student might not be earning as much, and they can always have the benefit to save the money they have and have more disposable income to use. This account also helps with financing a home in the future, as well as returning back to study in case that is your plan in a few years, which with most students, they don't always stop at just studying after college or university, which this account will help in case you want to pursue a career and education later. And the biggest advantage of this account, which will help students, is that it protects them from creditors, and that will help because as risks go along life, you never know if you'll be bankrupt, and that this account is protected from bankruptcy. Thank you for listening to this presentation, and I hope the information from this presentation will help you make better future choices in your financial year. Thank you.